I'm joined now by James Bevan, a Chief Investment Officer at CCLA, a special investment company that manages money for charities and religious organisations, including the Church of England. James, welcome this morning. May I begin by asking you about BP? You are a shareholder in BP.
No, certainly.
And obviously very tough times at the moment and concerns over the dividend.
Well, we have two rather interesting different issues. The first is the fundamental picture for the company, and the second, of course, is the political climate. In terms of the fundamentals, ICA company that enjoys revenues of around $300 billion, earnings before interest and tax of about $35 billion. I think that one probably has to assume that the costs to BP of the Gulf problems will be around $5 billion. One might reasonably expect punitive damages of, say, $10 billion, and impairment to Gulf values of around $11 billion. I think that means that the fair value share price is around 550 to 600 pence, a long way above the current share price.
Indeed.
The bigger issue, of course, in the near term is what does the political climate do to the dividend prospects and to the appetite to buy the company shares. There, I think the jury has to be out, and I suspect that there is a real chance the BP elects to simply pass the next dividend, simply because the political climate is really tricky.
This. We're just seeing live pictures now from the Gulf,
Absolutely.
and they are these kind of pictures that make it difficult for Tony Hayward.
Heart-wrenching and impossible, and Mr. Obama has a really difficult challenge as well, handling the political climate at home, and I think that the pressure on BP to pass this one dividend, or maybe the one after that, will be substantial.
But you would continue to hold, obviously, BP shares because you believe that they're undervalued at the moment.
BP has always said that it is after three things. It's after rewarding shareholders in the near term with dividends, about ensuring long-term value growth, and thirdly, of course, managing its balance sheet. It has a very conservative balance sheet at present.
Now, let's look at the bigger picture. There has been a lot of nerves recently in the equities market and concerns over a double-dip recession. Is that something that you worry about from an investment point of view?
Well, we have a real risk of talking ourselves into a problem, and I suspect that the biggest risk issue for the global economy is actual fiscal overkill. Therefore, we might reasonably assume that policymakers put the brake on too hard.
Right.
I think there is a real risk that that will happen. The rhetoric is very ferocious at the moment right across the globe, and if we find that governments and central banks do put the brake on too hard, we may well face that double dip.
Despite the fact that actually corporate earnings has all been really rather good.
I know.
Where there do you invest money in this situation?
I think there are some very good quality companies with sound balance sheets and exposed to good, fast-growing parts of the world. So I would look at, for example, Nestle and Diageo selling into China. We've had great news from China, and there I think that they will make a lot of money. I also think that parts of the tech sector are extremely well placed. Those are parts of the world that are very used to coping with deflation and the problems of rapid turnover in the cycle. And I would, for example, look at Taiwan Semi and Compal. I think European telecommunications are now just way too cheap. If you look at the high level of free cash flow yields, the strong dividend yields, companies like Vodafone are simply, in my view, mispriced. I also think that tactically people should be again looking at gold. I mean, really, if there was ever a safe haven from an economic downturn, gold is the place to be. I think there is probably another 10% upside in the gold
Really?
price.
So, and even at these levels, you would still advise buying gold?
Well, the cost of production a few years out is going to thoroughly exceed the current gold price significantly, and therefore I think that we'll probably see the gold price move up to around $1,300 an ounce.
And where would you be underweight?
I would be underweight any company that is dependent on financial leverage, of which there are a lot, and I would take a very contrarian call and be markedly absent government bond markets. To lend money to governments willingly on a 10-year view where the current interest rate is below the domestic rate of inflation just seems to me bonkers.
And now, what about the sovereign debt crisis that we've seen and the volatility within currencies? Does that concern you, that we've got a euro that's now plunging and doesn't seem to be finding much stability? How do you hedge against all of that?
Well, there's a certain amount of borrowing from Peter to pay Paul in the developed market currencies, the US dollar, sterling and the euro, and there I think actually they're all going to go down relative to the huge competitive advantages that the fast-growing emerging economies have. So if I were betting on currencies, I would be betting on the emerging blocks.
OK. James Bevan, thank you very much indeed for coming in and joining us this morning.